This chart visualizes the scale of the 2022 crypto crash. In a single year, over $2 trillion in wealth was erased from the market, a sudden loss equivalent to the entire gross domestic product of a major nation. The brutal reality of the cryptocurrency market is that individual fortunes are lost or erased overnight. Curious, slightly shifting tone. Now, artificial intelligence has arrived in this space, stepping into the volatility as a new variable, promising order, logic, and stability. But we have to ask if injecting machine learning into this market genuinely fixes its structural flaws, or if it merely hides them behind a convincing mask of technological control. AI currently operates within the crypto market in three distinct ways. First is high-frequency algorithmic trading, where AI models execute buy and sell orders in fractions of a second, moving at speeds no human could reach. Second, developers are deploying machine learning models that analyze millions of social media posts to forecast the price movements of Bitcoin and Ethereum based on public sentiment. Third, new integration projects are attempting to hardwire AI directly into blockchains, aiming to automate smart contracts and build decentralized data markets. The dominant narrative surrounding these developments is that these three pillars combine to make the market highly efficient, smoothing out the wild price swings and keeping the ecosystem safe. This narrative assumes that processing massive amounts of data is the same as uncovering the objective truth of what an asset is actually worth. Unlike traditional assets, cryptocurrency prices are not anchored to a stable intrinsic value. They are driven by human expectations and speculation about what other people will pay. This cyclical flowchart maps out exactly how AI exploits that speculation, creating what we can call a smart bubble. It starts here, in step 1, when an AI algorithm analyzes market data and predicts an imminent price increase. Trusting the algorithm's data, investors inject new capital into the market, hoping to catch the expected upswing. That sudden influx of human capital causes the price to actually rise, artificially validating the AI's initial guess. The prediction becomes a self-fulfilling prophecy. The system broadcasts this validated success, drawing in a massive secondary wave of eager investors, rapidly swelling the market into a precarious bubble. Eventually, the math stretches too far. The AI model detects algorithmic instability and abruptly reverses its prediction, initiating an immediate mass sell-off. With algorithmic support instantly withdrawn, the market collapses. The AI didn't accurately forecast the market. It constructed a larger bubble and then detonated it, weaponizing false confidence against the investors who trusted it. To understand why these models fail, we must look at the foundational promises of cryptocurrency, specifically the goal to create a decentralized system free of intermediaries. The technology secured clear technical wins, like facilitating cheaper cross-border transfers and establishing functional smart contracts. But it has failed to deliver on other core fronts. It lacks daily price stability, and it has not protected small investors from large institutional holders who still dominate the market. Because of this mixed record, there is a fierce debate over Bitcoin's identity. Economists point to the fact that you can't easily buy groceries with it, arguing it has failed its original purpose as a functional currency. On the exact opposite side, advocates maintain that its sole purpose is to act as digital gold, a secure asset designed to protect wealth against inflation. It is impossible for an AI model to accurately predict the long-term value of an asset when top human economists cannot even agree on its basic definition. This underlying uncertainty amplifies a macro-level systemic threat known as algorithmic herd behavior. In this diagram, you see the setup for this threat. It occurs when multiple independent AI models process the exact same market indicators simultaneously. They all reach the same mathematical conclusion at the exact same time, executing massive sell orders in the very same millisecond. Human panic takes time to spread, creating a natural friction that slows a crash. In this scenario, AI eliminates that cushioning, guaranteeing maximum collapse speed. The fallout from this speed is severe. In the real world, this looks like an individual investor losing 3 years of life savings in the span of a single week. This investor followed the algorithm's buy signals, trusting the math to time the market better than any human. A line of code executes coldly and silently, that the resulting financial ruin for a human being is devastating. When you follow an AI's investment advice, are you buying a well-researched financial asset, Or are you just buying blind trust in a machine that doesn't understand true value either?